And welcome to this introduction to Autochartist's Volatility Analysis tool. This is a small set of tools that gives the trader some useful insights into the past volatilities of an instrument. It enables you to get a better idea of the personality of the instrument in terms of its volatility. That helps when you want to figure out stop loss or take profit levels. And it also helps to refine your personal strategy in terms of what are the best times for you to be trading. Currently, the volatility stats are available for instruments where you see a volatility analysis button just below the details summary on the pattern display area. When you click this button, it opens a pop-up window with 3 tabs. Each of these will be explained separately. You can access the volatility analysis for all instruments available to you via this tab. Firstly, there is the price range forecast. At first glance, what you will most likely see is 5 green bars that are shaped almost like the trumpet, with the first bar being the shortest and the last being the longest. These bars are at the price ranges within which it is likely that the price will be moving. The first bar represents only 15 minutes, and that's why the expected price range is the smallest. The last bar is a whole day, and over a whole day there is naturally expected to be a much larger price movement than over just 15 or 30 minutes. The probability that this price will stay inside the green bar for the given time interval is 68%. It's important to understand that this graph is a forward-looking view, taken at a specific point in time. That time is indicated just above the graph. So, for example, on this particular graph, it suggests that there is a 68% likelihood that the price will stay between 1.1290 and 1.1334 for the 15 minutes following 3 p.m. Similarly, there is a 68% likelihood that the price will stay between 1.1262 and 1.372 from 3 p.m. for the next 4 hours until 7 p.m, is illustrated by this block. So how do we get to a probability of 68%? Well, this is a very straightforward concept in statistics called a standard deviation, and it is a deviation away from the mean, or the average. So what we've done was we've taken all the 3 p.m. candles for this symbol over at least the past 6 months, often more, and we've made a sample set of those observations. And we've used a standard statistical formula to calculate the standard deviation. Now, I won't get too technical, but with any sample set that follows a normal distribution, the probability that a new observation falls within one standard deviation on either side of the mean is 68%. How is this useful to you? Well, you can very well imagine that if you know the chances are 68% that the price will not be higher than this level by 3 p.m. tomorrow, you should not be setting your take profit higher than that if you want to be out of this trade before then. Or conversely, set your stop loss outside the green area if you want to increase the likelihood that you will stay in the trade for the duration of the applicable period. This view on the past volatility of an instrument at a given time gives you a realistic price region within which you can expect to trade. The next section gives a breakdown of price movement per hour. Unlike the price range forecast, this is not relevant to a specific time, but it looks at all hours of the typical trading day. Again, the green bars represent an average with a single standard deviation of either side of the mean. So here you're looking at an area of 68% probability as well. So at 2 p.m. my time, I can expect a 20 to 40 pip movement with a likelihood of 7 out of 10. What's interesting about this graph is that it shows you at what time of the day we've encountered the most volatility in the past. Often we see the most volatility around the times when the London and New York markets open for trading. If your personality profile is suitable for high risk and high volatility trading, then you'd want to choose those times of day where there is most volatility. If you're conservative, you may look for more consistency and trade at times where the markets are not quite so unpredictable. Similarly, the third section gives you a view on volatility on a day of week level. We see that Sundays show very little movement, but remember that it's not really a trading day. We have the markets in the Far East opening while it's still Sunday for a short while in Europe and America. Wednesdays are often more volatile for Forex traders as more positions are opened and closed to respectively benefit from or avoid the tripled swap rates that take weekends into account when there is no trading. In general, however, you won't see major differences in volatility from day to day, but remember that we're aiming to use every tiny probability that can give you a better chance at success. Trading is a game of chance, and you need to stack the odds in your favor, no matter how small the difference. I hope this was a useful introduction. Thanks for watching, and best of luck with your trading.